do the cloud. Here we go. Okay, so welcome everyone. Thank you so much for attending. I'm going to share my PowerPoint and we will get this show on the road. Hopefully you can see it. It looks like you can. All right, perfect. I just got to get it to, there it goes. Okay, so we're going to start off with the financial statement. Is the very first major report in your financial statement is the balance sheet. And so the balance sheet is a balanced equation. On one side, you have the assets, and on the other side, you have liabilities and members' equity. So the major thing when reviewing a financial statement, you want to make sure they're equal. The balance sheet should be equal. If it's not equal, something's wrong. That's one of the things that we look for on our accounting side and our manager side before we send it to you. But something to keep an eye out for too. We may explain why it might be balanced. There might be, I really can't think of a reason why I want to balance, but I'm sure there's one out there. So financial statements are snapshots of a point in time. So this particular one, it's a little old, but I get newer ones as we go through the slideshow. It's from July 31st, 2019. And so at this point in time, these are how the numbers align out. Now, as we know, as you progress through time, numbers change. And so this is just that little snap of the numbers at the time. So if we start kind of at the top and work our way down through the asset part of the balance sheet, your first part is current assets. And so these are all the potential funds that would be readily available to the association in the sense that they're typically current assets are more liquid funds. So in the event that the association was to dissolve, this would be money that you would have or could get. So we start off with cash in the bank. That was pretty self-explanatory. That's literally the cash that you have in the bank. Accounts receivable, that would be your amount that is owed to the association, so money that you have not collected from homeowners. We do run a modified accrual accounting, and so we account for the fact that you're going to receive all the funds that month, but that's not always necessarily the case. And the accounts receivable is what indicates what hasn't been received from what you have accounted for. And then 1265 is prepaid insurance. So these are very typical ones that you'll see. There are other account codes and current assets that you might see. And if you have questions about those, I'm happy to answer them, or so is your manager. But prepaid insurance, the way we work insurance is most policies require kind of a deposit up front. And so typically on policies, you pay anywhere from 40 to 60% up front. And some policies require 100% up front. So most of the time you are paying more. So we put that into a prepaid insurance, and then every month we take 1/12 of the premium, and that's what actually gets accounted for in your income statement. And so you'll see prepaid insurance, you know, it will bump up when you renew, and then it slowly starts to move its way down to zero as you reach the end of your insurance term. Designated and undesignated operating funds. So this is where we would account for operating funds that don't have a specific purpose, and then reserve funds, and then your reserve account. So this particular association has what we call a 1790 or operating contingency. The first thing I'm going to tell you about operating contingency is that it has it's the pass-through for the reserve. So anytime that we are paying reserve expenses, we move money from 1908 to 1790 to pay out of the checking account for those reserve expenses. So there are times where 1790 can be inflated or deflated based on the transaction of the reserves. Some associations have working capital, and working capital also bypasses through the 1790. And I'm going to show you on our next slide where you can actually find out how much money you have in your operating or how much money you don't have in your operating, because the opposite of 1790 is 1130, which is due from operating. This is where you've either borrowed money to pay operating expenses for cash flow reasons or for just budget shortages. And you'll see that as they'll have little brackets around it, and it'll be a negative number because it's money that you owe to a different fund. And most of the time that's the reserve fund. Oregon state statute does require that if you do borrow money from your reserves, that you have to come up with a reasonable plan to pay it back. And typically that would be done when you're doing your budget for the next year, because you want to kind of see how you're going to end the year. Because I've seen associations start the year with a due from operating and then end the year in actually a positive cash position. So it just kind of depends on what happens that year, you know. So there's so much that can happen between a year. And so right now, while we're doing budgets, would be the great time to look at, okay, do we have a due from operating? Do we need to come up with a plan to put into our budget to pay that back? Now, as I said,
What form does the plan need to be? Does it actually become a different line item, or is it some sort of written statement, or what?
You can do it a couple different ways. You can just kind of add it into your budget as a 1790, where it's just an additional operating contingency. I've seen other associations where they'll actually separate it out so that the homeowners know that the reason why we have this extra little increase is because of that due from operating and paying back the reserve for funds that were spent on operating expenses. So either way, and the other part of it too is that your plan doesn't need to be, it has to be paid back in a year, right? I mean, it's a plan and it has to be a reasonable plan, and it's up to the board to determine what they feel is reasonable, because that is so subjective in terms of, you know, what one person might think is a reasonable plan is different than another one. But you also have to take into consideration, why did you get into that position to begin with, right? So was it because you had this one-time event, like I'm going to use the February ice storm because that damaged so many trees, and it was very expensive for most of the associations that I have seen. You know, somewhere around the tens of thousands of dollars that you don't have lying around to fix trees that were damaged by ice. So that's like a one-time event that you really don't expect to happen again, to where you can kind of justify, well, we had to do it this one time, so we don't need to increase the budget. Whereas I've seen associations that don't necessarily take into consideration all of their expenses when they're budgeting, but then don't necessarily increase the budget to match those expenses. So it's figuring out what caused that due from operating will help you figure out how to fix it too. Because it might be that, you know, part of it is increasing the budget and paying back the reserves. So we'll get to budgeting in a little bit, but a little tidbit for you. 1908 is your reserve. There are some associations that have multiple reserve accounts, and so you'll see them all kind of designated as they need to be done. Like we have associations where you have residential reserve and then you have a commercial reserve, and so we keep those separate per the association's legal documents. Fixed long-term assets. Most people will see that this is blank. Most associations don't typically have long-term assets, but the most common long-term asset would be personal property. And this would be something like gym equipment, a vehicle, if the association had a vehicle, and items such like that, where there's a value to them that you could sell that value for, and that makes it an asset of the association. Typically, you'll see that, and then right underneath, you'll see depreciation. And the CPA will depreciate those items until it's nothing. But that's how you'll see that balance sheet. Are there any questions on the asset page before I move on? Okay, so the other side of the balance sheet is liabilities and equity. So current liabilities, this is going to be the shorter term liabilities. And so starting as accounts payable, and this would be for invoices that are pending payment. So we've received them, we haven't paid them yet, but they are accounted for in this month because we do accrue expenses. So anytime, that's why your financial's down a little bit later in the month, because we tried to wait as long as possible to catch all of those invoices to include, to give you that better snapshot. And then right underneath it is accrued accounts payable. That will show you the value of what we've accrued that month for the different expenses. And this is going to be, and this is where modified comes into place, is we don't accrue everything, which would be full accrual accounting. We only accrue what we know is going to consistently occur. For example, like utilities, we know you're always going to get an electric bill. You're always going to get a water bill. We accrue for, CMI expenses, landscapers, different things that we know are monthly and consistent, we accrue for. And the way that we accrue for them, if we have a value, we use that value. If we don't have a value, we use the budget value. So those accruals are based on what you have in the budget. So if you have $500 allocated in the budget for electricity and we don't get an electricity bill, we're going to accrue $500. So in some cases, when you're looking at the income statement, you'll see it's zero. My guess is you probably didn't get an invoice, and that was an accrual to kind of even out the playing field. Prepaid AR, this is a liability because it's money that homeowners have paid in advance. And so if the association was to ever dissolve, it would be money that you would have to pay back, making it a liability. There is a report that I'll show you a little bit later that will kind of explain the breakdown of prepaid AR, but it's pretty simple, just people who've paid in advance.
What's AR stand for? Accounts receivable?
Accounts receivable, thank you.
Okay.
Yes. Yes, accounts receivable AR. And then this particular association bills quarterly. And so they have this little extra little item on the bottom that's pre-billed HOA dues. And that is because they bill everyone quarterly, and then each month they go through and they actually do the billing on the income statement. So there's a little section of funds that are still not billed for yet. And so that sits as a liability until it's a billed. Long-term liabilities, there's two major items that you'll see here. I'm sorry, my dogs. Okay. And the first one would be a notes payable, which would be if the association had a loan, that line item would show you the principal of what is remaining on that loan, not the interest, only the principal of the loan. And then the other one is contract liabilities. So at the end of 2019, GAAP released a new guideline for how to account for the reserves. And basically, the accountants all got together and decided that it was a good idea, since the reserve is based on the reserve study, that be a liability of the association, because those funds are technically already spoken for based on the reserve study plan. So those projects are planned and you're funding for those projects, then that makes them a liability of the association. And so that's that contract liability line item that you see right there, the 2799, that's would match your reserve account balance. Members equity, so you'll see sometimes there'll be a reserve total down in the members equity, and that's if you have a loan, the loan does interesting things to the reserve, and so you might see something there. But the line right below it is the operating members equity. This would be the place where you could check and see how much available operating funds the association has, because this is a real hard number. So the top part right up there that's undesignated operating funds is the combination of pluses and minuses of the operating accounts since the beginning of the association. So the highs and lows, you add it all together, that's what you get. So for this particular association, they had 80K in operating funds that they pulled forward to 2021. The current year, they are running over budget by $200. So that's what the bottom line is, the current year's additions. And you do have to kind of be careful with current year's additions because there are expenses that occur annually, monthly, quarterly, semi-annually, randomly. And so that is going to go up and down as you progress through the months. And so you just got to keep an eye on that too. Any questions about the liabilities and the equity before we proceed?
Yeah, can you go over that members equity piece again? So help me understand that.
Definitely. Is there a specific question or do you just want me to go for it again?
Just go for it again. Yeah.
Okay, so the top line item of the members equity for the 3145 undesignated operating funds, that's the pluses and minuses of the operating fund since the beginning of the association.
And that's zero because essentially they've zeroed everything out over the years and they have no.
Well, no, some associations either run a net positive 1 year or a net negative 1 year. So in some cases, you run over budget, you have a profit. We're going to put it in quotes because you're a nonprofit. So technically you can't have a profit. But what that does is just roll over to the next year. And so let's say then the next year you run $10,000 over budget. And so you can use that operating fund to cover those losses if you have the fund. So for this particular association, they pulled $80,000 forward from 2020 and they ended the year overall as a net profit. Well, currently they're running a net negative of $200. So that operating fund can be used to assist with cash flow, right? So anytime that you have expenses that are quarterly or annual, you tend to bump up that month in terms of budget versus actual.
Got it. Okay. But then the reserves designated is zero here. And that, how does that figure into the members equity equation?
Correct, because that's the whole change in how the reserve fund is accounted for. So it's not equity to the association because it's not money that the association can just spend on anything it wants. It is allocated based on the reserve study for very specific projects. So that's why it's a liability of the association, because if you don't do those projects, then technically that's money that should be given back to the homeowners.
But here, explain to me why it's zero. Is it just coincidence that it's zero in this case, or would there really be, should there be a number there that they're going to,
no, because
in a year they should spend something?
Yeah, there's just no reserve equity for the association because their reserve is all a liability because it's based on their reserve study.
Okay, so it just confuses me that it's there as a potential equity number, but it actually will never have anything in it, right?
That is correct. Yeah. Because of that change in 2019, previously we used to put the reserve account as a member equity in the balance sheet. And so with that change, yeah, I don't know if that can be removed or not, but yeah, it should always be zero.
Carra, just to be helpful, is it possible to get a printout of these screens when everything's done?
Yes, Linda, you were here when I said it before. I'm so sorry, but yes, we're recording right now. So the recording will be available, and then I will definitely make my slides available to, I don't know, Laura, how we want to do this, but anyone who wants them, they're yours. You can have them. You can use them to help train your board, or I'm more than happy to come train them for you.
Thank you.
Could you email them to us?
Yes, we can. I don't see why we can't email them to you, Jim.
Okay, thank you.
All right, any other questions on liabilities and equity before I move on to I like to call it the fun part of the financial statement, but. All right. So next is the income statements. Oh, this is a lot tinier than I thought it would be. I might fix this slide. Income statements. A lot of people know them as profit and loss sheets. My accounting background makes me call them income statements because profit and loss just kind of scares me a little bit, but that's basically what it is, right? So it's your revenue versus your expenses and then your overall net. So every association should have two income statements, and some associations have more because the income statements are based on your funds. So if you have an operating fund and a commercial fund and a reserve fund and multiple reserve funds, then each one's going to have its own income statement. Now, to kind of give you just a side to side view of this is we'll start at this end. We have the current month. So in this particular case, July, actual expenses, budgeted expenses, the variance between the two, and negative meaning that it is under budget, a positive being that it is over budget. Accounting likes to be reversed. The actual line item name and title and account code. And then if we jump to the other side of the name, this is year-to-date actual, year-to-date budget, year-to-date variance based on dollar, year-to-date variance based on percentage, and then the annual budget. Some associations have slightly different looks of their income statement, but this is the traditional one. And basically when I review a financial statement, I spend a lot of time on the income statements because this is the comparison that you get of how you're doing, right? You can compare your actual numbers to your budget and see, are you on track? Are you headed the way you're supposed to? Are you running over? Do you need to slow things down? Or are you running under? And you can do that concrete repair that you've been putting off because, you know, you just wanted to see how the rest of the year was going to go. You can use your income statements to kind of do that. Now, if we go top to bottom, we start with revenue. The top line is always going to be your HOA fees. And then you'll have different various revenues depending on the association, kind of depends on what kind of revenue you bring in. And I'll talk a little bit in budgets about some different sources of revenue. There's not many out there, but there are some. But for the most part, the really only revenue a homeowners association has are the HOA fees paid by the owners, right? And so that's the top line item. Some associations invest their, I don't want to say excess funds, but some of their money into different kind of investments. And so interest can be earned. Interest can be earned on the operating and interest can be earned on the reserve. If you wanted to go somewhere specific, you just let us know and we can make that happen. Late fees, that's potential, you know, income for the association. I've seen some associations that have contracts with Comcast, like a marketing contract with Comcast, where they get paid quarterly or monthly from Comcast to market their services. I've seen WaveG do the same thing. And so there's a couple of different other sources of income out there. Some associations are sub-metered, and so they have income that comes in from the owners for the sub-metering. That would also be income that you could potentially see on an income statement. If you have an income line item that you don't know what it's for and you want to know what it's for, just let us know. We can answer those questions and let you know what is included in that line item. But a lot of it you'll be able to see in some of the reports within the financial statement, which I will show you in a minute. So that's income, and then it totals itself all the way down and kind of tells you how you're doing, you know, current versus budget. And then underneath that is the expenses. And so this is where I probably spend most of the time. And this particular association is kind of a bad example, but that's okay. You can see that they're actually running pretty fair to budget, except when you get down to landscaping. And then they're very over budget for landscaping. And when I look at something like this, I see, okay, well, they're over for the month, but how are they doing year to date? So then I go over to year to date and I see, okay, well, they're still running pretty far over. Let's see how they're doing for the year. Do we expect that there is any more landscaping items that could come up between now and the end of the year? Well, they're within budget for the year, but they only have, you know, about $2,500 left of that budget. So they may want to look into maybe dialing back some of the landscaping projects, or sometimes you just go over budget. And, you know, you may want to look at other line items to help offset that overage. Or if you have an operating contingency with some money, then maybe that's what you use to cover those overages. And then the reserve kind of works the same way, except the reserve, while we do have in some cases budget numbers, and certain associations are required to get approval from their owners for certain budget spending for the reserve. And so if you're unsure if you have to or not, just check with your manager. I can only think of 2 associations off the top of my head that require it, but so that would be where the budget may come into place. But the budget is based on the reserve study. So there might be chances where you're not necessarily using that budget for any particular project, because while it might be in the reserve study, it might not be something you want to do because maybe you want to do something else instead. And that's exactly why the reserve study is required by Oregon state statute and now Washington state statute to be updated annually. Any questions about the income statement? So I'll say one thing first. As a board member, this would be where I would spend my time, if it was me, reviewing the association's finances, because this would give you the how you're doing and kind of the knowledge of how each line item is performing and whether or not you need to pivot with your projects and finances.
All right, sometimes I look at math figures and my brain goes a little crazy here. So I'm looking at the legal line item on the expenses, it's account number 7255. They
Yes.
budgeted, they budget was 720. Did they spend 420?
0.
They spent 0.
Mm-hmm.
Yeah, what's the 420?
420
Is that the
year-to-date budget total.
that's the 720 divided by 12 times 6?
Yeah,
Is
so
whatever.
this
Okay.
particular financial statement is as of July 31st.
Yeah.
So that is the budget as of July 31st. So if we took 7 times 60, we should get 420.
Okay. Yeah, that's where
So.
usually when there's numbers in there, you can usually make sense of them. But when I start putting zeros in, then I get confused for some reason.
The non-numbers. Yeah, we'll get to it in budget, but legal is kind of one of those line items that's a little tricky to predict. So, but any other questions on the income statement?
If there were no legal expenses during this year, that would be $720 that were not spent, but were budgeted for. They could then use that if they had a contract repair, or it would be a positive addition to their carry forward money that they didn't spend. Is that right?
That is 100% correct. Yes.
Okay.
So that $420 that hasn't been spent, and let's say 720 if they don't spend it at all for that year, that is money that can be used towards other budget line items. They're pretty heavily over in landscape miscellaneous. So I'm pretty sure that if I remember this right, I'm pretty sure that they just ended up using it towards that. But I think of it kind of as a big pot. Your operating fund is a big pot. Now, while you have a budget, you have a guideline, you have room to move things around and kind of, you know, move the pot, shake the pot up. You know, you just don't want to take more than what's in the pot is the goal. I mean, it happens, but the goal would be to stay within the funds that are available in the pot. Okay. Anything else? Like we got more people than we did. Okay. All right, so just a couple other reports within the financial statement. Right after the income statements is a comparative budget. The idea of the comparative budget is to show you kind of a view of how you would end the year with your actuals up to that point in time and then budget for the rest of it. I know that some find that report kind of confusing, but that's the purpose of it, is to kind of show you how you would end, assuming that you spent all the money you budgeted for. The next report after that is the GL detail, or general ledger detail. So that is every single account code, every single journal entry that was done in that month. So we've been talking a lot about July 31st. And so all of the July journal entries would be listed in the general ledger detail, or GL detail. And so you could go through and kind of see, okay, well, landscape miscellaneous was over budget by $800. Why? You could go to the GL detail and see what invoices caused that line item to be so high. And if you're pretty handy with Avid, you can actually take the invoice number from the GL detail and look up the invoice in Avid to get more information if you wanted. Or you can ask your manager, either one. I know some like to look it up themselves, and so we fully support that. But we're also here if you need us. The next report is this one here, which is the summarized aged delinquency by owner report. And so there are two reports, one which has a positive balance and one that has a negative balance. So the positive balance are those who owe the association money. So if we were to look at the accounts receivable, or AR report, we could compare that with this delinquency report and see, okay, well, lot 1 owes $500 and lot 2 owes $1,000. So now they're 60 days past due. You know, we're just going to keep an eye on them. And depending on your collection policy, when we review it every month, that's one of the things that we look for in terms of delinquencies is, you know, most associations are 90 days. So once an account gets 90 days past due, that's when it gets turned over to the collection attorney. But this report will show you, you know, current, 30 days delinquent, 60 days delinquent, 90 days delinquent, and then 120 or more. And I should have included a report, but because it has names and account numbers, I didn't want to. But in the report, you'll see everyone listed. And then at the bottom, some associations have what we call 9 accounts. And so it will be a full account number and then a little 9 at the end. Those are accounts that are either pre-bankruptcy, so something we're very likely to not be able to collect on. We separate out from the main account, or it's an owner that is foreclosed or gone into bankruptcy that has a personal liability to the association for those funds. And so we track them separately in order to try to collect on them. So they're most likely not owners anymore at that point. So if you ever see those little 9 accounts on the bottom and wondered what they are, that's what they are. Those are normally created at the direction of the collection attorney. And then the other side of this report is the negative, which is great. The negative, believe it or not, negative is a good thing. That is the report of those who have paid or prepaid and have a credit on their HOA account. And sometimes you'll see that it's like 15 cents or things like that. And I've had associations that have wanted to just remove those to try to clean up the report. Honestly, I would just leave them. They're going to get cleaned up when the unit closes, and it doesn't hurt to have them there. Yeah, it's another little line that you can look at, but it's more work and you pay for more work to have us remove those accounts than it is to just kind of leave them there. if that makes sense. It really doesn't hurt anything. It's not a report that any buyer or seller is going to see because it has personal information. And so the board is really the only one that sees it. So you can just kind of leave those if you'd like. But with that said, we can still clean them up if you'd want us to. The next report after the delinquency reports is the accounts payable. And if you'll remember, this was one of the top line items of the liability. And so we can actually use this report to compare and kind of see what invoices are outstanding and what made up that value. And this report gives you that detail of the balance sheet. I'm going to proceed because I got a lot of these are kind of tricky. So there's another report right after this is the check register. Actually, I think before the accounts payable is actually the bank statements. And there's a lot of information on the bank statements, but I was having a hard time trying to get the bank statement to show on a report that looked well. But the major thing that I take from the bank statement and the check registry is your ability to link a check to a withdrawal within your bank statement. So just like this example, I can link the CMI, wasn't actually a physical check, this was actually an ACH transfer, but it does have a check number associated with it, to a withdrawal in the bank statement. So I can see that this check cleared the account on this date and they match. So if you have time and you really want to, you can go through your check register and your bank statement and match up all of the checks to all the withdrawals within your bank statement. Now, I have had people ask, well, can you do the same thing for deposits? Unfortunately not. And the reason for that is because of the multiple ways that money can be deposited. And because we work with ClickPay, as you all know. And so ClickPay will send the money directly to US Bank. And it's sent in either electronic transfers or in batches, depending on what it is. So if we get a bunch of checks at the lockbox, they're kind of all put together. And then the way that you'll see it in the GL detail is just kind of not clumped the same way that the deposits are clumped. And so that one's a little bit harder to track because you can't line them up as perfectly as this. You can line them up. It's just not as perfectly as the check register to the withdrawals. But it can be done. It's just, you got to piece together certain parts of the deposits, and it's a little bit of math, but it can, like I said, it can be done if you have the time and want to do it. This is the checking account bank reconciliation. So this would show you if there are any outstanding checks. Now, this is, while it says operating account, your checking account is your operating account, but your checking account is also used to pay reserve expenses. So you could see any outstanding checks would be listed here. I always like to keep an eye on it just to see if there are some that are, if there are any, because then it makes you a little bit concerned that an invoice isn't being paid timely. So I do like to keep an eye on that. And then the last page of most financial statements, I know I said income statements were my favorite, but I think this one's probably one of them too, is the investment page and additional bank account report. This is where everything but your checking account lives. So your checking account you see on your asset page, but then the rest of your money, you don't really see anywhere else in the financial statement because it's broken out by different parts. So this report actually shows you where the rest of your money is. So is it in US Bank money market? Is it in CDs? Is it in other investments? You have it in a, another bank. You'd be able to see it all broken down by that aspect. We do designate, so, oh, I made it go, sorry. We do designate, so for example, the money market account earns a little bit more interest than the checking account does. So anytime that we have the opportunity to, and there are certain associations that can't do this because of how their legal documents are stated, we do have operating funds in the reserve account in order to earn more interest. And so this particular association has operating funds in their money market account as well as their reserve funds. This is a very small association, by the way. So I know these numbers look interesting, but we're working on this too. So this association is over FDIC. So FDIC for a bank is $250,000. So US Bank would be all US Bank accounts for that association. So that means your checking account, your money market, and this particular association has a CD with US Bank. So all of those funds added together equal more than the $250,000 for FDIC insurance. This particular association did make an investment in August. You just can't see it. And so that's one of the things to look out for too, is to make sure that your funds are federally insured. Now, we are not investment bankers, so we cannot necessarily help you invest the money, but we can point you in the direction of people who can. The absolute easiest way to invest money is with US Bank using their CDARS, and we could give you Craig. Oh gosh, I'm forgetting Craig's last name right now. Information, and he can get that set up for you, or we can cut you a check and you can open up another bank account or an investment at a different bank. Because we are not a legal entity of the association, we can't do that on your behalf. Because of the relationship and the relationship we have with US Bank, we can open with board's authority the US Bank accounts, except for the investments.
Carra, am I looking at something wrong? It looks like they've got a little over 300,000 invested in US Bank, and the only interest they got was $1.05. Is that correct?
So my guess is that some of that is based on, so typically you don't earn interest on CDs until they mature. So they won't earn the interest on that US Bank CD until February 12th, 2022. And so the rest of it is probably likely either based on the interest earned off of the checking account or interest earned off of the money market. Right now, the rates for US Bank, except if you put it in a long-term CD, are not even a 0.01%. So, but I have seen other banks that have a higher percentage. I'm just not an investment banker, so I can't tell you which one, which ones they are. But I know, Linda, I gave you a few. And so there are other banks that are offering a better return on investment in terms of interest than US Bank. But I know that, you know, some associations are willing to do the research, and some just want to be insured. So whatever option, we can give you the information for that. Can't tell you to invest in one bank or another, but we can at least get you in contact with the contacts that we have at different banks. I haven't even seen a rate sheet recently to answer any other rates right now. I should look that up, but yeah. Any question on the last few reports that I went through or anything like that? Believe it or not, that's the entire financial statement. I know it seems like 30 pages long and I kind of condensed it into 8 slides, but that is really the entire financial statement. Are there any questions about the financial statement before I proceed to budgets?
Carra, I have one question. In my documents, my actual documents, financial statements look quite different from what you're showing on the screen. But if you go back up, not to this investment page, but the one previously about the ending balance from the checking account,
Mhm.
For example, our last sheet showed we had 2, 4, 5 apparently outstanding checks. So that was a negative $4,500. Those are the checks that are in the system that have not processed through completely, but were reported during this period, correct?
Correct. Yeah. So those are checks that have been issued but have not cleared the bank account and are not listed on the bank statement.
Okay, good, thanks. I thought so, but thanks.
I did think of one more question, Kara. I've noticed that when we have an expense from our reserve account, there's not a corresponding withdrawal from the reserve monies moved over to checking. To
So
match.
that's done via 1790. So in 1790, you will see the transfer from 1908 to 1790, and that is where it is released from your checking account.
But it's not always the same amount as what we're spending.
It might be a combination of certain things. Linda, I can take a look at your specific association and see if you want me to. But it could be a combination of a couple of different reserve expenses, or we do in some cases, we don't for your association, but in some cases we do move operating money to the reserve money market account for just, having the extra funds earn a little bit more interest than the checking account does. But like I said, we don't do that for your association. So I'm not sure why there would be a variance unless, yeah, I'd have to look at it, Linda, in order to answer specifically, but I can. If you want to tell me, you want to send me an email after this, I can take a look at that specific month. And we
Thanks.
can see, but yeah, 1790 is used as a pass through for reserve expenses to be paid out of the checking account. So it could be something different. I just have to look at it to see.
Kara, it's Carol. And when I look at our balance sheet, we do have operating contingency in the with the designated capital, undesignated operating funds. We have operating contingency, and then we have replacement reserve. That
Correct.
operating contingency is actually operating cash. It's not reserve money.
Correct. So that would be, so that section in the financial statement is designated capital, which is your reserve, and then undesignated operating funds.
Yeah, it's just because all the cash isn't in the checking account.
Exactly.
Okay, got it.
Hi, Carol.
Hi, Kara, how are you?
I'm good. How are you?
Just groovy.
I love how many people are on this that I've done this training with already. I love you guys. Okay, so if there's nothing else about the financial statement, and again, if you have specific questions about your association, I'm happy to, do a quick call or a quick Zoom and kind of go through some of those individual questions with you.
We'll have some.
Yes, Vicki. You guys got a lot of fun stuff going on at your association.
Oh, yeah.
You want to see a fun financial statement? That's a fun one. And we're making it even more.
Indeed.
Okay, budgets. So we're headed into budget season, and I gotta say this is my favorite because I love putting together budgets. But remember, I'm the crazy math person and I love numbers. And so, but some things to know about budgets. They need to balance. I know that sounds crazy, but I've had people give me budgets that don't balance. Your income should equal your expenses. There are things that we can do to force those to happen, but it's very important when you're paying attention to your budget that you can't have less income than you do expenses because you're already putting yourself in a bad position. And you don't want to have more income than you have expenses unless you can explain the difference. So you really do want them to balance. And then budget should take into consider when you're budgeting. When I go through a budget, the first thing I try to figure out is I'll spend, you know, a few minutes on every line item, figuring out what expenses occurred. Do I think those expenses are going to continue to occur? And then are there any projected rate increases for those expenses? So you take historical data and you include projected rate increases, or in some cases, I've seen associations add in projects that they know they want to do in, you know, the following year to their budget so that it's accounted for and proper and has the proper income that it needs. Now, it's very important to pay attention to your legal documents because not everything you want is necessarily something you can put into your budget. The association is responsible for the maintenance and care of certain components, and the owners are responsible for the certain maintenance and care of components. And then there's this little middle ground in between that we call limited common elements. And so depending on your legal documents depends on how those can be budgeted for. Common area expenses 100% of the time is something that you would include in your budget. The limited common, depending on the association, can depend on who is responsible for that expense. In some cases, limited common could be HOA, which you would include in your budget. And in some cases, it would be the owner, which you would not include in your budget. And then there are owner-only components, which of course the owners are independently responsible for. Now I bring this up because I had this come up with an association a few years ago where they wanted to add to their association's HOA fees and budget doing window washing. Well, window washing for this particular association was the expense of the individual owners, and the component was an owner component. So legally, that is not something that they could put in their HOA budget because it's not an HOA responsibility at all. But we got away with it and added it not to the budget, but to the fees that were being assessed to the owners, as if the association got a way better rate doing it all collectively. And so we were able to expense it to the owners, but not through the budget. So just something to take into consideration is your budget needs to be what you are legally responsible to collect HOA fees to maintain. But if you have something that you want to do that is owner only, like we have an association that the owners are responsible for dryer vent cleaning. Well, we helped them coordinate the dryer vent cleaning, and then we charged each of the homeowners through their homeowner account for the dryer vent cleaning because it was a better cost to each individual owner. And so there are things that can be done that allow you to get those group discounts that don't add them to the budget. So the main thing.
So your company helped out with that, but it's not on the budget books. It's on a totally separate bookkeeping effort.
Exactly. Yeah. Yeah. Now, in some cases, we do charge for that service. In some cases, we don't. So just make sure that you check with your manager or your contract in some of those cases, because that is an additional thing. It's not always included, but it is. Just talk to your manager and confirm. Every contract's a little bit different. So I can tell you most of them, it wouldn't be an extra charge, but some of them it might. So it just depends on your contract with us. And then the coordination of it also might be something that we might have to charge for. It just depends on the contract. But your manager would be able to tell you if it's an extra expense or not. And if they don't know, they just come to me. So I wouldn't worry too much about that, but it is something we can do. When you're budgeting, I know it's hard to try to get board or to get owners to buy into this, but if you can, include a contingency, include an operating contingency, include a little extra money that will help you with the unknown. There are so many things that could potentially happen that you just can't plan for. And so industry standard is to have an operating contingency of 5 to 10% of your total annual operating budget. But depending on the size of your operating budget, just to give an example, an association that has an annual operating budget of $150,000, they would maybe want an operating contingency of $15,000. Well, this particular association during the ice storm that happened in February paid almost $30,000 in tree damage. But they only had an operating contingency of, they had less than 15. And so you kind of also have to take into consideration the amount. While 10% is great, you may want a little bit extra depending on what that ends up being. Because if you only bring in, $150,000, $15,000 might not be enough to cover some of those unknowns. And so that's kind of the main purpose of having that operating contingency or that contingency. We do have some associations that are required to have a reserve contingency. And that's a completely different horse and completely different requirements that would be based on your legal documents. I've seen a lot of interesting things that legal documents have come up for budgeting. And, while I'm not an attorney and I do not play one on TV, I've read enough legal documents to try to kind of figure out a lot of different cases. And I've seen a lot of documents to where, I've seen associations that have budget caps, like you can only increase your budget by a certain amount, or you have to get an owner's vote or anything like that. So knowing that aspect of budgeting as well is very important. Your manager should know, but I also think it's very important for the board to know as well, because you have to plan for that. We're seeing so much cost increases right now on everything. I mean, those who are in the Tualatin Valley Water District, I am so sorry. I can't believe that they are increasing their rate by 10%. I mean, we're just seeing these really, really big rate increases across the board this year that I've almost never seen. I will say Tualatin Valley did increase 16% like 4 years ago, but that's a different story. So building in that contingency just gives you the opportunity not only for the unknown, but also for, some known causes too, that you may know this is coming down the pipeline and you're going to, but you don't necessarily know how much it's going to be. You can put in a little bit of a contingency to pad it. Now, I understand that sometimes that's hard to sell to the owners. And I say the easiest way to sell it is we don't know what's going to happen. And because we don't know what's going to happen, we want to put in a little bit of a buffer so that if something happens, we have money for it and we don't have to come back to you and ask you for more money.
Well, we have a operating contingency fund. And I think when we last spoke, our confusion was that account code was being used as a pass-through for reserve funds, because we actually fund that for projects that have taken longer or got deferred, so that we would indeed have the money in there, or those unanticipated expenses that we've seen historically, to come up and bite us in the rear end. So having it play a dual role from CMI was quite a shock to me when I said, well, no, this is our operating contingency. We put money in there, and it's, well, it's a pass-through for your reserves. I'm like, oh my goodness, I have to start thinking differently, because it's watching now for different expenses that we had not intended to come through that account code, go through it, because they're expenses that are coming out of our reserve dollars in all actuality.
Yes, correct, Vicki. So just to further explain on that too, is that most budgets, when we put in an operating contingency, we put in the operating contingency under 1790.
Yeah.
And Linda, that might solve your other problem with the operating contingency money looking interesting, because I bet you, because you guys have an operating contingency too, I bet you the other part of that fund is that transfer for operating contingency. I bet you. We can check, but I bet that's what it is. But yeah, so that's 100% correct. It is a dual function account code. And so that's why I always tell people, you know, don't use that as your basis for what you have available in your operating account. And, you know, maybe I need to work on coming up with a different plan for how that should be accounted for in the future. But that 3145 on the members' equity on the other side of the balance sheet is your true operating fund. That is where you can go and check and see how much available operating funds you have. Oh, I love it. The next part actually explained everything I said. Okay, include a budget line item for legal, bad debt, and general property maintenance. So legal, you never know when you're going to need legal advice. And I got to tell you, attorneys are expensive. You know, I mean, they're averaging between $350 to $450 an hour. That's a lot of money. And they charge 10-minute or, you know, 0.10 increments. So it's definitely a good idea to have just a little tiny contingency in there, unless you know it's going to be a big legal year, like you have some projects or some rules enforcement items that are coming down the pipeline that are going to need more legal. Then definitely plan accordingly. But I've seen associations get rid of legal and then end up needing a lot of it during that year. So nobody wants to pay the attorney. I know it. I don't like it either. But sometimes it's the better option to make sure that you're making the right decisions for your association. It's part of that whole fiduciary duty as a board member you have to your association, and being able to get the right advice and take the right actions for your association does sometimes require the attorney. Bad debt. I've seen associations have bad debt and I've seen associations not have bad debt. I would say the only reason to add bad debt to your budget is if you know you're going to have bad debt. So if you have a couple of accounts that are on the borderline or have been a collection for a long time, you may want to start budgeting to have to write off those accounts. Do everything you possibly can beforehand and wait for the attorney to tell you to write off the account. Because there are some accounts out there that may have a money judgment, and those money judgments are good for 10 years. So don't write them off quite yet. I have seen an association collect on a 10-year money judgment in year 9. So they ended up starting a new business and getting a bunch of assets, and we were able to garnish and pay off the association's debt. So I've seen it happen. But I've also seen there are certain bankruptcies and foreclosures that you have to write off the debt. And so you just got to keep an eye on those things and put bad debt in place. Now, I know one of the questions I'm probably going to get is, well, how much should you put in? I think it just depends on how much you think you might have coming down the pipeline. I know associations that do a certain percentage. So they do 1% of their operating budget is what they keep in a bad debt fund. I've seen associations just kind of keep it the same value every year, just as a placeholder in case they do have a bad debt. And then again, I've seen associations not fund it at all because they have a operating contingency that the bad debt could come out of. There's several different ways you can fund for it, but it's something to take in consideration when you are budgeting. And then we'll call this my favorite line item of the budget is property maintenance, 6690. It's the catch-all for everything. And it's one of those line items that has so much flexibility. And because of that, it goes like this year to year to year to year. So it's so hard to properly fund for it because it's kind of almost a maintenance contingency in and of itself. But I have seen associations not fund for maintenance and then have a whole bunch of maintenance expenses. So just be realistic with it. You know, if you're going to have those one-time expenses come up, and so that property maintenance is definitely a line item to make sure is funded. And then consider the community needs and issues. For example, is there a rise in pet waste? And are you potentially looking at adding pet waste stations? Oh, yeah. Where there are currently non-reoccurring expenses in the previous years. Okay. Garbage signage. Okay, perfect. So I kind of already covered that, but you know, are there certain things that your community wants? I mean, landscaping is another one of those items on the budget that is very subjective, because you can have a community that's like, just let it go, let it be natural, you know, let's reduce the budget. And then I've seen other communities that want it pristine and, you know, I'm going to use the word perfect. That's going to cost you a little bit more. And so is your budget meeting the needs and the wants of the community? And sometimes you're not going to appease everyone. And what one person thinks is beautiful and right is probably not what somebody else thinks. So you, as a board, you're trying to come up with the best for everyone, or the majority, as many as you possibly can. And so if you have an issue where you are constantly having pets go to the bathroom in this one section of landscape and they can never pick it up, then adding a pet waste station may help that problem. And it might be something you want to include into your budget. I got a lot more on budgets, but if there is any questions, stop me anytime.
Here, I want to back up just a little bit. You were talking about 6690 for property maintenance.
Yes.
What's the difference between 6690 and 6345? 6345 is building maintenance. What's the difference between those two?
You know, Linda, you're going to have to tell me that one because that was very unique for your association. I
Which
think
one?
for your association, the difference is the 6345 is for contracted maintenance services. And I think 6690 is for anything else, if I remember your budget correctly. It's been years since I've looked at that.
Okay.
But I'm pretty sure that's how I would do it. If I was doing a budget and I wanted to separate the two, then I would use 6345 building maintenance as those maintenance contracts, those annual contracts, whatever kind of services they got going on. I would put those under there, and then anything else outside of those contracts would fall into 6690.
Okay.
But I'd have to look at your budget to confirm. I remember you guys have a lot of different maintenance line items too, right? Because you have roof maintenance and roof and gutter or something like that too. So you have a few different line items, if I remember.
Okay.
Right. Okay. Cost saving ideas. This is probably your favorite, right? I'm going to try to give you some cost savings ideas. Unfortunately, a lot of them may not be 100% available at this time, but they may be in the future and something to consider. So the first one is, additional potential income. So interest, if we could ever find a better investment. Clubhouse rental fees. I know some associations charge them and some don't. It's another source of income. But I also know some associations feel like you already pay for the clubhouse, you don't need to pay again. So that it's an idea. The thing with other potential, and I don't know if I have it on here. I don't have it on here. So another potential income is Comcast and Wave G and a lot of these internet and phone service providers and cable TV providers are doing marketing in, incentives for associations. I just had another association. I don't manage it, but somebody else. And I heard that they just recently, they're getting like $15,000 a month. Now they're 300 plus units, but I mean, that's a lot of money to be getting just by sending out information, because you don't have to guarantee that everyone's going to use the service. You just have to send out marketing material. So an idea for some potential income would be, maybe looking at your service providers and see if you did some marketing for them, if you could get paid for it. I know quite a few associations that have it. Bidding out service contracts. This is probably going to be the major cost savings idea I have, because it's kind of really the easiest one to do. Is that you might be able to find someone who will do the same service at a lower price. I just would caution you. I mean, if you like the vendor and they're doing a really good job, it's hard to transition from one vendor to another. So if you're going to make those transfers, just make sure that you're making them logically, if that makes sense. Don't, sacrifice great service for bad just because it costs less. Because it's going to put more time on me as a manager. It's going to put more time on you as a board. And then your community is going to get all mad because, Joe did a great job, but now Bob doesn't even go out there. So just tread lightly, but it is a great way to try to find some cost savings for your association, is to get additional bids. Now, with that said, because of how hot the construction market is right now, trying to get bids is almost impossible. So tread lightly, and you may not be able to get 3 bids in some cases, because there's just not the vendor pool right now available that there used to be. I don't know if that's going to change. Some costs have started to level out in the construction world, that it looks like it could trend that way. But right now it's still just such a hot market that I don't see it changing anytime soon, at least into next year. I mean, because I have some contractors that are booked until next year. So that's an idea, though, would be bidding out some contracts. Upgrading the building. So Energy Trust of Oregon, I actually just did a project with them for updating exterior lights for an association. And I think the total cost of the project was like $50,000. And they got somewhere around 14 or 15,000 from Energy Trust. So there are some money available for Energy Trust. Now, when I talked to them, which was probably about 2 to 3 months ago, they were saying that their money available was running out. And they're already starting to book projects and funds for 2022. So if you do have a project coming down the pipeline, it doesn't hurt to get Energy Trust of Oregon involved to see if there's any funds available for that project. This would include items such as lighting. I've seen them pay for some window replacements to more efficient windows, HVAC units, and things like that. So upgrading your building, you might be able to find some Energy Trust of Oregon money.
So what if we discover a building upgrade project that we want to do, but it's never been budgeted? Where do we draw the money, kick off that project? For example, for Energy Trust, we might have to invest money up front on a design and a bid and whatever. But there's nothing in the budget for it. Is that where we would borrow for that? From the reserves, or where?
I guess it would depend on the project. So while you may not have funds available for it, There might be, so like, let's just use the lighting for an example, because it's the easiest one I can think of right now is, so exterior lighting on your building, let's say it's an HOA component and you need to replace them because they're all starting to fail, and it's going to be better to replace them all at once, more cost effective. And you partner with Energy Trust of Oregon, and they are able to give you some money to, to fund that project. But this is not a line item in your operating or your reserve. Where does the money come from? I think that's your question, right?
Yep.
Well, I would say that it would be a reserve expense that wasn't properly reserved for. So it's something that you would use your reserve funds for. And then when you do your reserve study update, you would update it to include it in the future and to include that as a deduction from your reserve. Assuming where your association legal documents allow it. Because like I said, there are a few documents out there that do require reserve projects to be approved by the owners. So we would just have to check your legal documents and make sure there wasn't anything fun in there that would restrict that. But 95% of the associations, that situation would be handled through the reserve. And then you would do an update next year that would include that project and refund the reserve. It's going to recalculate all the numbers over 30 years by adding that project in.
Okay, so you kind of amortize it that way over time. Is that the way to
Exactly.
think about it? Okay.
Now, if you were Linda's association, you would have to get board approval or owner approval, and you wouldn't be able to do that.
Okay.
But like I said, 95% of the associations, that is something you could do.
Yeah, and we did do that, and we saved a boatload of money on the common area lighting. It was a huge benefit, so I recommend anybody else look into that. It's a great deal.
Yeah, those bulk energy trust programs are wonderful. I have an association that is on the docket for 2022 they're replacing all their HVAC units, and they're getting a bunch of money from Energy Trust. So you can always check with them. They may say they have money, they may say they don't have money, but I mean, anything that you can get for free is just a savings for each individual owner. I say go for it. The worst thing they'll say is no. Conservation of common area utility usage. So this would be, for example, if the association had common water. So each of the individual unit owners use water that's paid for by the association. There's several different entities out there that will give you like faucet fixtures that allow for, reduced usage flow, changing out your shower heads. PGE has an entire package of light bulbs that you can get that are reduced wattage so that you can save electric and things like that. So that's another cost savings idea, is replacing in-unit components that are paid for by the association. I would say most associations have at least water or gas. I've seen some that have electric. And so coming up, encouraging the owners to update their fixtures to more, conservative methods would definitely save the association money. And lighting, I got it. Updating your lighting. I've seen an association where they went through and there was 40 owners, I think. And every owner got a little kit from PGE. They gave it all out at their annual meeting. It was great. And this was when we could meet in person. And they all got a little kit and were told to go home and change out all their lights. And I mean, within 2 months, you saw a pretty drastic dip. So while it seems small, it can actually make a pretty big impact. So just encouraging them to update. And toilets. I had one association that they had toilets from, I want to say the 60s. Like they had a lot of toilets from the 60s and 70s that were kind of starting to fail, and their water bill was just super high and it kept going high and high. And I was like, you got something going on. And it ended up being that they had a bunch of toilets that were leaking. And so they gave an incentive to the owners to change out their toilets in order to save the association money. So, and looking at that income statement that we talked about earlier is an opportunity to see that kind of trend. You know, I'm gonna throw Carol out here. She has this beautiful spreadsheet of every single code, every single line item for every single, and she just tracks it like it's beautiful. And I mean, the value she adds to her association, and I'm sorry, Carol, for throwing you out like this, but I got to do it, to her association, just because of how much she watches the financials, is huge. I mean, she knows where every single expense is, where every single expense goes, and they're able to stay within budget and, you know, keep a pretty good, reasonable HOA fee because of, you know, the extra effort of keeping an eye on those finances.
Carol
I
is
know
our,
it's
Carol is our pot of gold. You know, one other way to save money, our landscape company mentioned to me a few years ago that updating our irrigation system throughout the complex, updating our irrigation, because some areas get too much water, some get not enough. And apparently it hasn't been updated in many, many years, but we stand to gain quite a bit of savings on water usage by that. So if anybody hasn't updated the irrigation system, talk to your landscaper.
Yeah, Linda, that's a great point. And I've seen a lot of landscapers recently making that recommendation to associations because, you know, when you've hit about 20 years on a pipe that's in the ground, and it's not that far in the ground, it does tend to get a lot of wear and tear, and it is good to replace that. And if you have a good reserve study, that should be in your reserve study to replace that. And definitely something to look into. I've also seen landscapers recommend different control systems for irrigation to kind of regulate how often they're watering. I can't remember the name of it and it's going to bother me, but there's a system out there that will actually use the weather to determine whether or not to water, because, you know, sometimes we get rain into July. Heck, we just got some the other day, so that it won't run your irrigation if it knows that it's rained. And that's another cost savings idea for irrigation. But there are ideas and different things out there. And if anyone else has any that they'd like to share with the group, I'd love to hear it. Okay. All right. So I hope you don't have to make this decision at one point, but I did want to touch on it because it's something that has very recently come up a lot. I know a lot of our associations are starting to age and get into a position where, you know, they may not have been properly funding or their reserves, or there are projects in their reserves that were, you know, 25 years out and now at 20 years need to be done because they just have failed early. So when should you do a special assessment versus when should you increase your HOA fees? It all depends on circumstance, right? You have to take quite a few things into consideration. You know, is increasing the HOA fees going to cover the deficit that you need to make up in order to fund what you need to fund? You know, are those increases something that is palatable to the association? You know, I mean, while you need to make sure you're funding, you also need to make sure that you're not pricing yourself out, right? And so it might be better to do a special assessment than it would be to increase your HOA fees, depending on circumstance. While neither of them looks good in the market, When you look at the long picture, you know, if we do an assessment now and keep our HOA fees of where they are, or do just a minor increase, then your increase will look trajectorily different than if you just did big increases for the next few years in order to catch up on funding. So, and then the other thing to take into consideration is, what are you funding for? Are you funding for a shortfall in your operating budget? Are you funding a large project? You know, what is the goal financially? Because that will help give you the option of different things to do. You know, is it something that's too expensive to even fund through a special assessment or an increase? You know, right now, getting an association loan is probably the easiest I've ever seen it. When I first started in this industry, it was rare, incredibly rare for an association to get a bank loan. And now it's a dime a dozen. I'm seeing them left and right getting bank loans, and banks just loaning money like nobody's business. And they're actually doing it at very good interest rates. And so, you know, I'm seeing more associations being able to do those bigger projects that they never thought they could do because of the price tag associated with them, by being able to do an association loan. And you know, if you're going through that kind of situation right now, you know, I have an option sheet I put together for an association that I would be happy to share with anyone on options for funding big projects, or funding, you know, combination of reserve projects that right now just don't fit within your current HOA fees. So that's kind of all I have for you. I think I'm on time. Look at that. I am, with a minute over, but I'm there. I'm going to say it's because we got off to a late start. But are there any questions? And I'm happy to answer specific questions about your association offline. But, you know, if there's generic questions, I'm all for them.
So generic question for me on budgeting. I'm used to having quote unquote a budget committee kind of form towards the end of the year and develop an approach, a plan for the next year, and then dissolve and then kind of come back together again, you know, the next year. It's not a continuous over the year
Like an ad
process.
hoc committee.
Yeah. So is that typical, do you think?
It is. It's a good thing. I got to say, if you have volunteers that are willing to do that, I applaud you. I don't see it as often as I would like. Just because, you know, a lot of it's hard to get volunteers, right? But I personally like budget committees because they're the ones who kind of help the board come up with, you know, expenses. And while I can put together a pretty good budget, it's always better to have the owner input in budgets if you can get it, because they're paying it too. And so the more owners that express interest in something like that, I think the better budget you're going to get.
Yeah, I think so too.
It's your property, it's your association, it's your money. I mean, you know, you have to take some ownership in that, I believe. I always tell people when I'm helping an association, I always try to treat them like they're mine. And so if I can save you money, I will save you money.
Is there anything that's coming around in Oregon as a result of this tragedy that happened in Florida? I didn't know if there's any rumblings or groundswell of.
Not yet.
Okay.
I do expect that maybe the next session we might see some legislation come through. Right now, the biggest legislation that just recently passed is that allows homeowners or associations to meet virtually. And then the other one is it's a House bill regarding discrimination. So if you haven't already, you do want to get either a committee together or legal counsel together to review your legal documents for any discriminatory language that needs to be removed. That is a requirement of this new House bill, must be done. I think it's by the end of 2022, if I remember correctly. And it goes into effect January 1st. And so that's kind of one of the major legal things that came out of this recent session. There's some fun stuff in Washington if anyone wants to know Washington. I don't see anyone from Washington on here, but I don't know. But yeah, that's about it for Oregon. Any other questions? We are planning to do this quarterly, so I think our next one, and Laura, you can correct me if I'm wrong, isn't it December? I don't remember the topic. I should know this. Yeah, so we'll have one in December, and we'll do a little bit better job of getting this notice out earlier. We had some technical issues, and so I apologize for that. But yeah, our plan is to do this quarterly, and you know, if you have a topic that you think would be good, I do plan to bring in guests to help me teach, so that you're not just hearing me talk all the time. As fun and as exciting as that could be, I'm not an expert on everything. I'm not an expert enough to be dangerous, though.
Will the quarterly meetings be the same topic or new things?
No, it'll be new topics. So I know that we have like a reserve study one, and I think, oh goodness, I should have the list. Yeah, I think one was even maintenance, if I remember correctly. But yeah, we have several different topics, and I'm happy to add topics to the list for training ideas if anyone has any.
Really, Avid.
Oh yeah, you
Andy,
know, that's a good one. We should do Avid. It's kind of my baby, but yeah, we can do Avid.
kind of my nemesis.
Oh, Vicky, you do a very good job in Avid.
Would you like to have a conversation about Avid and Vicky? I think it would be very beneficial because there's so many options, and yet there are some really significant limitations with Avid and billing and invoices and research. So that would be my topic.
Okay, I will add that to the list, Vicky.
Thank you.
Anything for you.
Oh,
Okay, well, if there aren't any further questions, I'll let you proceed with your evening. I thank you so much for joining me, and I hope to see you next time.
Thanks a lot.
Thanks, Carol. It was great.
Thank you.
Thank you,
Great job.
Kara. Appreciate it.
yes,
Good job, Kara.
looking forward to the series.
Yeah.
Me too. Me too. I'm really excited that we got this moving. I think it's good, and you know, as a board member, you only know what you know, right? And so if we can teach you anything to help us and you do a better job, I'm all for it.
Well, thanks again. I appreciate it.
Well, my
Good night.
pleasure. You have a great evening.
All right. Thanks again, Karen. Have a good
Thanks,
evening.
Linda.